Howdy, Jacob here. Today we're looking at SilverBow Resources in the oil, gas, and consumable fuels industry. A little bit under $1 billion market cap on over $2 billion enterprise value. We do have a lot of net debt here. Let's look at that debt first. So $1 million in cash and cash equivalents with $1.2 billion in long-term debt. That is concerning. That is saying that I've done analogies like this, but it's equivalent to you having percentage wise $1,000 cash on hand and you have a $1.1 million loan outstanding. I mean, to have $1,000 cash with that type of loan is ridiculous. It's the same with companies. For $1 million cash on hand and 1.1 billion in long-term debt, 28 million short-term debt, that is a huge concern of mine. The cash from operations shows that they do not have positive free cash flow, so they've been going into debt to fund projects, likely acquisitions over here, and yeah, you can't be that. There's not longevity in just going into debt to fund projects. You need to fund projects in the long term through your cash from operations and free cash flow, which we are not seeing here. And I mean, outside of that, growth and revenue is all over the place. Their margins are surprisingly consistent on the operating side, but again, we talked about cash flow in the last 2 years. They're not producing any. So the cash flow is lifeblood of the business. Earnings, get manipulated through GAAP and everything. And so if you want to truly see if a company is gushing out money, you look at their cash flow statement, and we are not seeing that here. Let's start making some assumptions. I don't think it's going to be pretty. I mean, I don't know what's going to happen. I'll probably just do, when I don't know, I try to just do maybe 3 and 13. So 3% revenue growth, roughly in line with inflation. 13, slightly lower than the market PE, price for cash flow at the end of 7 years, based on this. And what I'm seeing in the numbers, I think that's fine. I just don't know what to put, really. So I'm just really throwing out numbers here. The fact that their cash flow is so much less is a huge concern of mine. A 30, 15. They've been adding shares too. I mean, the company just hasn't been doing anything of that what I would be doing with this type of business. So, I mean, again, there's two ways to fund a business. It's through issuing shares and issuing debt, and they've been doing both to fund their acquisitions or whatever. And I'm just not interested right now. 41% with these assumptions. I don't think these assumptions are close to where I would be putting it at. If I were to do a deeper dive, I'd presume that it would get ugly pretty quick. So I think that every positive earning company has a valuation to it. So if you're going to give me this company for $1 million, maybe on the excessive side, I'd probably do some research and be able to sell off some things on the asset liability side to be able to produce that, make that investment a good one. But at 878 million on the market cap, 2 billion enterprise value, I just don't see it being worth it at this price point. Hopefully, short video, but hopefully you enjoyed the video and have a great rest of your day. Thank you.